It's Hey guys, how you doing? Um, Warren again, Quant Warren in your house. I just wanted to talk to you guys about something today. I actually had recorded this earlier, but something ended up happening. Not really sure. Actually, let me just turn the music down. Give me 1 second. All right. Sorry about that. So, all right. So I just wanted to, I know, look at the forums, and a lot of the times I see what traders say and everything about their struggles. I just wanted to throw a few pointers out there really quick for you guys that are interested, for you guys that are traders that are having this issue. The first thing that I think that is critical is that someone has the right information. It took me many years to bump into the right information because there's a lot of disinformation out there. There's a lot of people that are out there that don't know really what they're doing at all, but they're selling things and they're, pushing these ideas that, in a practical sense, just don't pan out. And for the purposes of making themselves money, and in the meantime, traders like us, you know what I'm saying, we end up taking the fall for it, which is not right. And so I just wanted to share some insights that helped me when I first started becoming profitable on a consistent basis with my trading. This is a style, admittedly, that I don't follow anymore. My last video, I actually explained to you guys why I don't. I'm not a fundamentalist. I'm a technician. So I do technical analysis and then algorithmic and machine learning based off of the technicals. So based off of price action, essentially. But a lot of institutions do not trade primarily off of price action. And as a matter of fact, many of them almost completely disregard it, for the in large part disregard it. So I'm gonna explain that to you guys. It's gonna be a quick video. I just want you guys to get an understanding of how to do this trading thing and be consistent and be consistently profitable. There's more to it as far as from a psychological aspect. You know what I'm saying? As far as you maintaining patience, discipline, and controlling your emotions. But as far as what is tactically sound, what is strategically sound, I'm going to give you that, guys, today. And I hope you guys enjoy this video. So what we're going to talk about is fundamental analysis. All right. So my mentor is a hedge fund manager. He is a fundamentalist. So that means trading off of the fundamentals. And basically what that looks like is, so you have the big major central banks. You got the BOJ for Japan. You got the BOE for England. You got the Federal Reserve, or the Fed in short, for the United States. You got the RBNZ for the Royal Bank in New Zealand. You got the RBA, Royal Bank of Australia. You got all these major central banks, right? And each one of them control interest rates. And at the bottom, at the end of the day, currencies move off of interest rates. That's it. I mean, well, there's other things too, like safe haven flows. It's kind of like a separate but interconnected dynamic. But all in all, a currency is going to move because of interest rates. And if you look at it from a practical standpoint, if you had one bank that was going to offer you 30% return on your money, and then you had another bank that was going to offer you 0.001% return on your money, where are you gonna go? Where's your money gonna go? It's gonna go to the bank that's offering you 30%, right? So it's just as simple as that. On a global scale, people are gonna move their money where the interest rates are going up. It's just so that is the essence of successful trading, is to figure out where the money is moving, and you can easily do that by way of studying the fundamentals. So I want to go over that really quick. Sorry, guys. So the biggest thing is starts from interest rates. So markets spend all of their time being forward-looking, looking to see what the next quarter, next 2 quarters, next 3 quarters, what that's going to look like for whatever central bank. But as far as you guys, and then I don't want to make it too complex and in depth, the basics is I'm going to make it as basic as possible, and that is that what you want to do as a what's called sentiment trader, which is a fundamentalist that trades, that jumps into like fundamentally based positions based off of current sentiment, is what a sentimental trader, or a sentiment trader, I should say. Sorry about that. What that is. And so what that looks like is you basically find super strong currency or strong currency one, then you got a weak currency two. And what's weak and what's strong, basically, if you have a central banker, or if you have a central bank that is moving interest rates down, if they're on a downward trajectory as far as interest rates, they're cutting, right? Or in other words, in industry terms, being dovish, right? And that's their track. That's a weak currency, all right? And then conversely, if you have what's called a hawkish central bank, and then that means that they're moving interest rates upward, they're on an upward trajectory, they are considered to be hawkish. And then you have the in-between kind of middle ground, where a central bank is on standby. So they're on hold, they don't really, they're not moving up or down, they're not on any type of track, but they're just keeping interest rates steady. And that can be hawkish or dovish, depending on the rhetoric coming from the major central bank members of that central bank. So, but that's don't want to get into all of that, because that kind of just adds extra unneeded complexity for the purposes of you guys that are trying to gain some consistency right away with regard to this trading thing. The biggest and the easiest thing, you want to find diverging interest rate policies between central banks. So you got your currency pairs, right? So let's just say, for example, you got let's say pound, Great Britain pound, and then US dollar. Let's just throw that out there. Okay, so you got those two. Let's say United States is, for whatever reason, hiking rates, right? And you can easily find out what the trend of rates are. There's a free tools online. Forex Factory is one of the big ones that you guys that may already know about. Forex Factory. There's another few, FX Live. There's a few of them, but let's just say, so the United States is hiking. They're on a hiking cycle for the last few quarters. They have been moving up, and every time they release their announcement post hike, they kind of just lead you to believe, or lead the market, I should say, to believe, well, yeah, more than likely we're going to be, continue to tighten up on interest rates for A, B, C reason. Then conversely, you have Great Britain pound, you got the UK, and the MPC, which is the Monetary Policy Committee, that's for the UK, the BOE. They're saying, well, the economy is just run down. People need, it needs to be stimulated. The economy needs to be stimulated. We're going to be cutting interest rates. We're cutting it. And so now you have a situation where it's a clear cut. This is where you make money. Okay, you're going to be. And so now in this pound dollar situation, the convention, as you guys that are traders would know, it's a pound dollar. What you would be doing is then shorting off pound dollar, and essentially buying the dollar versus the pound, or selling or buying the dollar and selling the pound simultaneously, however you want to put it, whatever, shorting off the pound, and you hold it, and that's it, and you hold it until the fundamentals change. And the tactical part to this strategy is to get in as the sentiment is in an immediate shift. So fundamental analysis is like the personality, right? So let's say the market has a base personality that doesn't change all too often. It may change every few months, every few years, whatever. It's kind of like a human personality. But then you have your daily moods, right? Those change every few hours, every few days, whatever, right? And that's sentiment. And so, sentiment short term, fundamentals long term. So, a lot of the times you can trade against fundamentals if you know what you're doing. If there's strong sentiment in the opposite direction, but also keeping in mind, that eventually the fundamentals are going to kick back in play and the trade is going to continue. So you better be, very, very tactical with such situations like that. Don't think that beginners should try that. A lot of the times market fades off what appears to be contrary sentiment. So it's definitely not a good thing to do, because institutions, I should say, big banks, big equity firms tend to buy and sell into those liquidity pools of opposing sentiment from the fundamentals, and you'll catch yourself in a situation where you become liquidity for a big order from a big institution, and that's not where you want to be. You want to be on the side of the big institution, and they are always on the side of the fundamentals because they trade long positional type trades. So over months, over years, a lot of the times it takes certain institutions, depending on how big the size they're trading, may even take them weeks to actually even get into a position. So, they're not in and out like how retail traders are. It's a different dynamic completely. But nonetheless, so I'm going back to making money on this situation. Let's say, like, okay, now we know we're going to short off pound dollar, right? And so it's Monday or it's Sunday, and you already know that the fundamentals are this direction. It's weak for the pound, strong for the dollar. Then you look on Forex factory calendar, the economic calendar, and you see that the consensus expectation is, let's see, the consensus expectation for inflation for the MPC is quarter over quarter going to drop by 0.7% down to like 0.3 from its original, whatever the situation is. You want to look for a high impact event, and it'll show you on the calendar. They are marked in red, and a lot of the times it's really not even all so much about what is traditionally considered a high impact event, but more so about what the central bank is looking for. And that's another thing that you guys should pay attention to, because a lot of low impact events that people consider quote unquote low impact, if the central bank is looking at it, the market's going to take it as a high impact event, and vice versa. If it's a traditionally high impact event and the central bank has already communicated to the market that they do not, for whatever reason, not gonna say they don't care, not looking at that, they already know what the situation is and they're looking at something else, then you will see a muted reaction, and maybe even an inverse reaction than to what you expected upon the release of that event, even if it comes out as expected. All right, so going back to sentiment. Now, when you have a sentiment trade, what you want to do is trade either into or out of a sentiment trade. You don't trade. I see a lot of traders online. What they'll do is they will wait until the news event, and then they'll jump all in, and like it's all like, oh, yeah, it just came out like you don't want to do that. One thing, there are panels out there that do in-depth market research that have feeds that most retail traders do not have access to. They know what the result of any specific event is seconds before you guys know, sometimes well before that, and depending on what it is. And so you're fighting a losing battle trying to jump in when Forex Factory calendar releases an event. By the time they release the event, everyone has already known for a while. Everybody that moves the market, I should say, has known for a while. And so you're never gonna ever win a situation like that. Don't try. I'm telling you what I know. It's not a good idea. So I've had feeds where as though I have gotten the events well in advance of everyone else, and you don't want to get caught in a situation like that because you will get burned. Sometimes it'll work out in your favor because the market is just so strong in that direction that even if you get in late, it's okay. But you don't want to make that a practice because you're getting in late, regardless to what you think, regardless to how you feel or what the market looks like when you get in. Trust me when I say, if you're getting in at the time of an event, you're getting in late because there are many people that have already pre-positioned well before you. And what you want to do is you want to either trade into or out of an event, depending on the situation. So let's just go over, and I'm going to make this simple. Trading into an event. Let's say you want to short off pound dollar. You know that this week, let's say, going back to our original example, inflation is supposed to be going down again. The consensus expectation for all the economists is that it's going to be dropping by 0.7% quarter over quarter. Okay, so you want to short off pound dollar already. Now you have a situation where, okay, this is going to shift the sentiment, right, in my direction, even if it was in a different direction for whatever other reason before. What you want to do is you want to get in at least 24 hours before the event is released. And sometimes, and really, and I was taught, you get in at the beginning of the week. Most big institutions position themselves at the beginning of the week. Sunday at 5 o'clock, 6 o'clock, into European session overnight, 3 a.m., 4 a.m. Everyone's really already positioned for a trade. Now, sometimes what they'll do is they'll kind of do fake outs in order to be able to get a full position in. Meanwhile, making it seem as though the market's going in a different direction, and then you guys end up getting caught out, and then you find out at the end that you were right all along and you should have just held your position. So that would look like, let's say maybe the price starts off at 1.3. They may and it's going down. It may go to 1.25, and you're like, okay, it's going, but then it'll go back up to 1.3. And then there's a reason for that. Like, they're accumulating a position. That's called an accumulation zone. So it's not that the trade is falling apart, it's that it's still accumulating. There are people that move the market, and these people are accumulating. So they're going to do these types of tactics in order to, one, get liquidity, and they get liquidity by basically essentially taking money from retail traders, the vast majority, right? And then that's the first thing. But then the second thing is that they have to build their positions, because for a retail trader, you can get in like that. It's no problem. If you're trading and each trade is a billion lots, or let's say 2, 3, 4, 5 billion lots. Now imagine that, like you are a market mover at that point, and you can't just jump straight in. You're going to end up screwing yourself because you're going to give your hand away, and people are going to see that big spike of volatility as you place this humongous order. It's not going to be good. They don't do that. They do what's called ghost positioning, basically where they layer their positions in. It's all around the same level, but it's very inconspicuous. For the most part, unless they catch a big liquidity pool. A lot of the times they'll let's say, for example, if they know that pound dollar is going short, they might push pound dollar up through a resistance level and then make everyone else that doesn't know what's going on feel like, oh, well, it just broke the resistance. Let's go long, not knowing what you're doing. And then as soon as it pops up, close, bow, it's right back down, and they rip it straight through, and they put their whole position right on top of you, and you lose, and you feel dumb, and it's not a good feeling. And when I first started trading, there's been a lot of times that I have seen stuff like that happen to myself. I've seen that happen to other traders. You don't want that to happen to you. So please, keep it simple. Simple is the best way. And, so if you're going to be trading, if you don't have a viable strategy already, I strongly suggest that you start out with the fundamentals and then using the sentiment to get in. You're not going to be in a position where you're getting profit necessarily right off the bat. Like, a trade that's fundamentally based, which is why I moved away from fundamentals. The fundamentals can be in place for a very long time, and a trade can take a very long time to reach its what's called fair value, depending on, because there's many different cross channels, many different cross currents in a market, and that will prevent it from getting from point A to point B in the time that you feel like it should get there. It'll get there, but just not exactly necessarily when you feel like. And that's one of the things that turned me away from fundamentals. However, fundamentals works 100% of the time. That one thing I can say for a fact, that if you trade the fundamentals and you trade it consistently and you trade smart with risk management that's smart, you will consistently see profits coming in. No doubt, one of the best traders in the entire world, traded the fundamentals only. And as a matter of fact, there's not even just one, there's a few, but one in particular that I'm thinking about. And it works. I've done it, no problem. It works. Trust me when I say. So for you guys that are starting out, that's a simple way to start out. Interest rate differentials, you want something that is moving the opposite way. Because if you have something that is converging, right, then it's going to favor the lower interest rate. You want it diverging, right? So relative interest rate growth, diverging, not converging. In other words, pound and the dollar should not be moving closer together as far as their interest rate differential. It should be moving apart. If it's moving together, the one that's lower is going to be the one that people are going to start buying into, because as I said, the market is forward looking forward all the time, weeks, months, quarters, and sometimes even a year or more in advance. So they're not looking at right now, they're looking at down the line. And if it's converging at some point, it's going to crisscross and diverge in the opposite direction. So you don't want to do that. Always make sure that you're getting diverging interest rate differentials, and then you guys can get into the specifics of how that happens, whether it be different geopolitical events that happen that change the dynamics of the central bank's position, whether it be different fiscal policies that change the dynamics of the central bank's position, There's a bunch of different things that come in play with regard to that, because you got to remember the central bank, they have two mandates. The main mandate is price stability, right? The other one is jobs, but price stability is number one. So when things get when people are buying too much, when people are spending too much, guarantee the interest rates will start to rise, because they're going to have to tighten it up, because where there's higher demand, there's higher prices, and they have to control those prices, and vice versa. If people don't have a lot of money and the economy is too tight, and they're going to drop. And so there's a bunch of different situations like that. You guys should look more in detail as far as economic models, and what makes up an economic model, and how central bankers will interpret different aspects of their economy. But that right there is something that you can do later on, not something that's necessary to make money from trading the fundamentals right now. Long as you have diverging interest rates and you have a sentiment-based setup, you're good to go. And then I would strongly suggest that you figure out, go deeper into why, the specifics. It's always good to know why, but as far as making money, that is the key formula. I wanted to give you that, guys, today, for you guys that are struggling to make money trading. And that came from a professional hedge fund trader, not someone that's sitting here talking a bunch of BS and spouting a bunch of. I'm talking about somebody that is very up there, that I had the blessing to have as my mentor a while ago, and so I'm telling you some good stuff, and I think you guys should try it out. It works, you'll see. And if you have any questions, let me know. All right, so Quant Warren is out. I'll see you guys later. All right.